You are listening to Keystone's Stock Talk Show, episode 186.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to be with you again this week, albeit still fighting off this nasty virus that many of you have been getting over the past month. Good times, I'll tell you. I don't wish it on anyone. We will kick this week with a brief look at the FTX bankruptcy fiasco in the crypto space over the past week, giving you a timeline and some comments. We will also look at Elon's mess at and on Twitter. Aaron is set to take you to school this week with a quick look at earnings quality when reviewing an individual stock. I will also look at our star of the week, a client or a company that clients should be well aware of in our US research. Bowman Consulting Group, symbol BWMN on the NASDAQ, an organic and growth professional services firm delivering innovative engineering solutions, including planning, construction, management, commissioning, environmental consulting, geomatics, survey, land procurement, and other technical services to customers operating in a number of regulated end markets. The stock jumped 20% in the past 2 days after issuing strong Q3 earnings and increasing its guidance. Brennan hits the mailbag and answers a listener question on Fiverr International, symbol FVRR, on the New York Stock Exchange. It operates an online marketplace worldwide, enabling sellers to sell their services and buyers to buy them. So I'm going to get to the show. I'm going to welcome my co-hosts, Aaron and the Killer Bees. They're both back again this week. Brett was there last week, but Brennan,
just saying, it was a horrible show last week.
Out of the crypt.
I'm out.
One arm out.
Kinda, yeah. Still coughing, but still coughing out of the coffin. But
look at that. He doesn't sound as chipper, does he? What's going on with the guy?
A little rough. Yeah, it's a lot of
he's
work.
Wrecked.
Yeah, a lot of stuff going on in the office. Yeah. So
that's a good way to start a show. Thanks. For that. Yeah, Brennan's got his heart.
It's good to have you back. I thought it was a horrible show last week. There's no chemistry.
Thanks, Aaron.
Apparently there was zero ratings.
Well, this chemistry seems really good here.
Yeah.
So let's go. Yeah. Let's go with that. So let's start. Brett, we've got a lot to pack into this show, so we might as well get right to it. Not talk some pleasantries here, which we have none for each other right now. So yeah. So what happened with FTX? Tell us what it is. What the hell is going on here with this SBF character?
Good one. I'll first just say I'm gonna be skipping over quite a bit of it. It's a whole mess of a case. I'm trying to stick to the core details.
Good.
So
why don't we start with what it is? What is it?
Well, FTX is an unregulated cryptocurrency exchange based out of the Bahamas, and it has collapsed recently. Something which, it's happened before with cryptocurrency exchanges, and as everyone knows, history never repeats itself, so who would expect this to happen again?
Never.
No, never. I kid, but the difference in this one is the FTX was huge, so comparing it to other exchanges that have collapsed before, the first one, the big one, which is always cited as Mt. Gox, one of the first Bitcoin exchanges, if not the first, depending on how you really qualify an exchange, that fell apart in early 2014, which it at the time, Bitcoin, the entire market cap was 10 billion. So the entire market cap of cryptocurrencies as a whole was 10 billion. FTX was valued at 32 billion just earlier this year. So entire Bitcoin in 2014, 10 billion. FTX, 32 billion. Mm-hmm. So the reason why it got so big was they lured in significant investment from SoftBank, Kevin O'Leary, Tiger Global, and even the Ontario Teachers Pension Board. One of the other notable ones is the prominent VC fund Sequoia Capital, and it was just purely starstruck in their meeting with the CEO of FTX, Sam Bankman-Fried, or SBF. Sequoia partners were practically begging to give him money, while he was, as all serious CEOs do during meetings, he was playing League of Legends, which Sequoia, they were displaying this on their website until very recently, where they wiped it off now. So really, what happened? Did all these people and funds just do no due diligence, or something more happening under the surface at FTX? Let's take a quick look back. SBF's Sam Bankman-Fried founded FTX in 2019, and it quickly became the go-to exchange for many institutional investors looking to gain access to cryptocurrencies. He was constantly in the public eye. He testified in front of the U.S. Senate, a major political donor to primarily Democrats, but also to a lesser amount Republicans. And only a few months ago, he was an altruistic savior of the cryptocurrency space when he bailed out Voyager Digital, supplied liquidity to others following the Terra Luna collapse. He charmed institutional investors and many cryptocurrency users over the last few years, leading to the rapid expansion of his firms. So how did the man, who everyone was seeing in these great eyes, he was a great person, wipe out billions practically overnight? The collapse of FTX is a case of fraud, poor management, and conflicts of interest. The direct downfall of FTX was against its own terms of service. They lent out customer deposits, primarily to its trading arm, which technically a separate company, but in reality it's the same company. It was owned by the same people. The way they were interacting, it was the same company. It was the same organization. Put up an organizational diagram of how they were interconnected. It's just a mess between all their subsidiaries, but we'll focus on FTX Alameda for this. Alameda Research was ran by the 28-year-old and supposed girlfriend of SBF, Caroline Ellison, who had previously stated they only use elementary school math to run their risk management services.
Yeah, absolutely could pull it off without my math degree. Use very little math. Use a lot of elementary school math. Being comfortable with risk is very important. We tend not to have things like stop losses. I think those aren't necessarily a great risk management tool. I'm trying to think of a good example of a trade where I've lost a ton of money. Well, I don't know. I probably don't want to go into specifics too much with that.
Having bad trades is just one thing in a trading firm. It's expected. You're going to have some bad trades. You're going to have losers and winners. But at the time of that interview, she was likely using funds fraudulently gained from FTX to fuel losses that she was accumulating. The public collapse of FTX became apparent in early November. The public got its first glimpse in the chaos of Alameda Research on November the 2nd, a leaked document showing the massive hole in the balance sheet only covered by its sister firm's FTX's FTT token. The same token that FTX can print in the former central bank would like $1. Having the token on its balance sheet it's not a surprise, but roughly $6 billion of the $14.6 billion of assets were in FTT. So about 40% of your assets are something you can print, and in reality that doesn't have value when you can print your own. And worse, Alameda was using FTT to leverage itself. So if FTT can't easily liquidate or sell the token off, it can't pay its liabilities, which of course, that's what happens. On November the 6th, the CEO of Binance, CZ, the largest competing cryptocurrency exchange, held $2.1 billion of FTT and announced its plan to liquidate its assets as it was exiting its FTX equity position, which it previously held equity in. It was one of the early founders of FTX, early capital providers of FTX. And as that's announced, people ran for the exit. And it caused the insolvency of Alameda and FTX, causing a bank run of the customers' deposits. Lynn Alden puts this event into a wonderful analogy. Imagine McDonald's makes its own money, let's call them clown bucks, keeps most of it, sells some to the market. McDonald's then uses the remaining clown bucks as collateral for actual loans. And then people remember clown bucks aren't real. And then Starbucks comes and market sells the clown bucks they were holding while reminding the market clown bucks aren't a real thing. McDonald's balance sheets is trash with their clown bucks wiped out. Anyways, that's what happened in crypto land that week, is how she concludes.
I like that, clown bucks.
Yeah, it's a great one.
Wow.
Yeah,
So they took
great.
customer deposits
Mhm.
and they used that money so that they could make high risk trades.
Yeah.
Which they then lost on.
Yep.
Right.
And they
So just imagine that. Like, you put your money in a bank, say, right? You're maybe getting a little bit of interest. You're expecting that it's going to be there when you go to make a withdrawal. And they go and take that money and they bet it on the most riskiest things they can bet it on. And if they win, they keep all the money. And if they lose, you lose all your money.
Yeah, I mean, the fact that they had no wall between their trading firm and the exchange is insanity. But I mean, apparently
Wow.
this goes on all the time. I mean, brokerages do it more than, in the equity world more than we'd think.
But brokerages don't use customer deposits as fund to fund their trading business either, though. Like, that's
we would
what
hope
brokerage
not.
does. Well,
has it
I
never
think if they
occurred
were,
ever?
it would have.
Has it occurred ever? Ever?
Has it occurred ever? Oh, I mean, I'm sure to
there
some
we
extent
go.
it has, but
No, I mean, this
sounds
is, I just, how did this, 30 something or under 30, basically, like, he was a former trader. That's what he was. He's a former trader, and he convinced millions of clients, or over a million clients, some of the wealthiest in the world, without a great deal of due diligence, to invest either in or via a Bahamas-based cryptocurrency, which lacked a basic board of governors and really much oversight with any teeth at all. The exchange had a partner firm, Alameda Research, which is his own trading company, which had a significant performance of it, or portion, of its assets in FTX's native token, FTT. Its own crypto, as I understand, which basically, I mean, I can't value. It has no value, but people bought it. I mean, to me, it just appears that fear and greed drove people insane, and there was no basic due diligence being done into this company at all.
Pardon? They liked his energy.
Well, I mean, and that's what
he had a good story.
That was literally posted on
matters,
Sequoia's. Right? Sequoia is one of the largest VCs in Silicon
methodology.
Valley.
We liked his energy.
Yeah, well, no, that was part of what gained him. Listen, no, but honestly, it's part of what gained him the capital in the seed valuation was his amazing energy. And Brett pointed out, in those moments, he was playing League of Legends?
Yes.
As he was pitching this, and Sequoia, the entire investment committee, was wetting their pants over his vision of digital currency in the whole world. Like, he wasn't taking any of this seriously. It's not like this was an original programmer that was programming the blockchain, the technology behind this. This was an individual who was a trader selling them on something, really. I mean, he went to MIT. He's likely fairly bright, but honestly, and then the others he had involved, like, if you look at the trail here, his girlfriend was the CEO of Alameda. And like, do a couple Google searches on her. I mean, she's from MIT as well. Probably relatively smart, can do the math. But, what were some of her...
needed elementary school math.
But some of her biggest quotes were, you have to, being comfortable with risk is very important, and giggling as she said it. And this is who you're trusting with $10 billion to be the CEO of that company.
Of
and then
energy, though,
she was, sorry?
No, go ahead. I'll let you finish there.
Well, she was asked about outlining times when she lost money and saying, after musing over it, she said it was hard to figure out a time when she can recall one, but she could probably not get into the specifics of the time she had lost money, and then just laughed it off. Like, these interviews are out there, and people have invested in this firm and put their clients' capital in these companies. I mean, it shouldn't shock me, to be honest, but it still does shock me that investors put money behind companies like that without significant due diligence. I would say don't always follow the herd. The smart money can also be really, really, really dumb. And if you don't understand something, don't invest in it. Blockchain for me appears to be a wonderful technology. The world is continuing to look for like many use cases that may change the way we conduct business. But to force its success on millions of crap coins or some NFTs that hold little intrinsic value just doesn't make sense, and really is going to lead to fraud and has led to fraud and just sad losses in people's portfolios. And to be honest, they should take responsibility for those losses, because you're investing in something without understanding it, without having any ability to gain a fundamental value or intrinsic value to the whatever you're putting your money into. Stick to businesses that you can understand in regulated industries with your hard-earned dollars, or this can happen.
Yeah, certainly. It reminds me, just talking about his energy, it reminds me of a quote from Warren Buffett. And I'm sure I'm not going to have the quote perfectly, but he said that when he's investing in a management team, the 3 requirements is that they need to be intelligent, they need to have high energy, and they need to be ethical. And he said that those 3 things together is what makes a great management team, what makes, in turn, a great investment. But he said if you only have the first 2, the intelligence and the energy, but you don't have the third, the ethics, then that's essentially the worst case scenario, because they will actually absolutely kill you.
Yeah, and that may have went on here. Yeah, exactly.
Yeah.
Okay, so what do we want to get to next? Do we have anything else we want to dig into? Aaron, you've got, you wanted to talk about Elon's escapades at Twitter?
Just to kind of follow
or do you want to
on the
just go into
segment
your
we
segment?
did. I mean, we could just talk about it really quickly. Just to follow up on the segment that we did last week. We talked about a little Twitter feud between Elon Musk and AOC over the $8 verification feature that Elon was introducing to Twitter. So they got in this feud. We covered it, and it seems like only days later, Elon Musk had completely reversed course, and now he's eliminated the $8 paid verification. So I guess AOC was right all along. Wait, you agree, Ryan?
Made a few people.
Huh? Sorry, I didn't. Did that happen? So that it's been dropped completely?
Yes,
Oh, yeah.
my understanding is yes. And can you?
Yeah, my point. I'm not sure if I believe you were on the show, but I don't
proves
think
AOC right, doesn't it?
No, but I'm saying I don't. I'm sure you were on the show, but I'm not sure you're listening to the show. I don't think that was my point, that AOC was right or wrong. I was making a point that it was absolutely, that what she was talking about in terms of not like in terms of charging that, right? Was his right, and to say that it's not his right to do it is the whole point, right? And it is his right to bring it in and take it away if he wants. And for her to complain about it, well, she can complain about it. But the other point was too. There was. Pardon?
I didn't listen to the last episode, so I wasn't there.
No, and clearly the two things really had nothing to do with each other. So essentially, what happened, from my understanding,
well, I think that he dropped it because of our debate on here.
Probably is what that's what happened. Yeah. No, what from my understanding is what happened is, and when I heard about this, I thought like, okay, well, he's adding $8 to the vetting process so that anybody can be vetted to get this verification on Twitter. Well, I guess no, it was just about the $8 and not about the vetting, right? Because you essentially had a ton of clown accounts show up paying the $8 and then impersonating other businesses like advertisers, other companies, other people with their blue check mark. So that's why he took it down. But I don't know, just a strange turn of events. He introduced it as his first big feature change, and then within a week had to do an about face. Now, I think there's a lot of things that you can criticize Elon Musk for. One of the things I've always said, though, is that I think that he's maybe possibly one of the greatest engineering minds of the generation. But now I'm not so sure, because you would think that just completely eliminating the vetting process would cause some problems and have some people taking advantage of that. But anyways, Just a funny term.
Yeah, and I might argue he was better at the marketing of electrification than he is of the actual engineering behind it, potentially.
That may be a very good argument.
Yeah, for sure. Good. Now, okay, let's get to your segment on the quality of earnings.
Sure, excellent. So as people know, anybody who knows Keystone knows, we are stock investors, and what we do day in and day out is we research stocks, we research companies. A big part of that is looking at the financials, looking at the earnings, looking at the cash flow. So this is something that we've covered recently in our webinars, in our VIP in-person seminars. But I just wanted to pull out a couple of slides from that and talk about a subject that I think it should be important to most investors. And that's the subject of earnings quality. And really, can you trust earnings that are reported by a company on their financial statements, or the earnings that are then re-reported or redistributed by financial websites like Yahoo or Morningstar. So if you're an investor and you're doing a financial analysis of a company, you're going to spend a lot of time on something called the income statement. So this is where the company records all of its revenues, its expenses, and its profits. And right at the bottom of the statement, you're going to see something in every statement, a line item called net income or net earnings, net profit, net loss, which is going to tell you how much earnings the company has reported for that particular period. Now, the question is, can you trust this number? And the answer is no. Unfortunately, you cannot trust this number. And there's different reasons why. There is the possibility that there's dishonest reporting. But a lot of the times it has nothing to do with dishonest reporting. It's just the way the accounting system works. So there are major limitations to the income statement that people need to consider. And they need to consider this when they're using data that doesn't come right off of the income statement. Say, for example, if you're getting a price to earnings ratio or some type of financial information from Yahoo Finance, because their information, their earnings probably comes right off of the income statement. So one of the big limitations to the income statement is that net earnings may not be a good representation of real earnings. And so what would real earnings be? Well, real earnings is what we would consider to be the cash profitability that a company generates in a particular period. Now, one of the things about the accounting system is that we have these things called accruals. And that means that you want to match revenues and expenses that are associated with the same period in the same period. So you can be reporting revenues and you can be reporting earnings, but you don't necessarily receive the cash from customers in that period. Now, according to accounting rules, you would still report that as earnings on the income statement. And if you receive that cash maybe in the next period, it's not really an issue. But what happens if you don't receive the cash? So that's a major issue to consider. But there are also other items on the income statement, like gains and losses on financial instruments that don't impact the cash flow and aren't really part of the business operations. Right? So here's an example of an income statement. And if somebody were to look at this and go right to the bottom, they'd see 22 million in net income, up from a loss of about 11 million in the year before. And that looks really impressive. But once again, we can't just take this number at its word. We need to look through the income statement to see if everything looks legitimate. And right away, I can see a couple of things. Fair value on adjustment to assets, $46 million gain. Investment income, $1.4 million gain. So this is significant, and this needs to be considered. This brings up the subject of adjusted earnings. So you take the earnings that you get that are reported from the company, you go through the financial statements, and you make whatever adjustments that you need to make in order to bring those earnings at something that you'd consider to be close to cash flow profitability. So adjusting earnings is absolutely necessary when you're doing analysis. A lot of times earnings can be overstated, sometimes they're understated, but you need to know what goes into that figure. In Canada, typically we refer to this as adjusted earnings. In the United States, they typically refer to it as non-GAAP earnings. So just taking the previous example there, we had 22 million in reported earnings, but then we removed what we considered to be non-operating, non-cash flow relevant line items. So investment income, we removed the 1.4 million, fair value adjustment to assets, we removed the 46 million. And this brings our reported earnings down to our true adjusted earnings of negative 25 million. So we go from positive 22 million to negative 25 million by making these adjustments. But there are also risks to using adjusted earnings. There's also risks to making these adjustments. So a lot of times earnings will be overstated and you need to make adjustments to bring earnings down. But perhaps just as common, or maybe even more common, adjustments are made to reported earnings in order to make them look better than what they actually are. So some of the common adjustments that we see would be, of course, the non-cash gains, losses on financial instruments, like asset write-downs, other non-recurring expenses, maybe associated with researching, acquisitions, stock-based compensation expense. Some of these, it's black and white. Should we adjust them? Others, there's an argument to be made on either side. But it's important to know what is going into the earnings figure. So one of the rule of thumbs that I look at is how far does the reported earnings figure deviate from the adjusted figure, and also how far from the cash flow. If the difference is fairly minimal, then it may not be something that you need to really spend a lot of time researching. But if there's a major difference, you really have to understand. So here's an example of a company that reported adjusted income from operations of $473 million for the year. But when we unadjust these earnings, we can see that the reported loss from operations was actually a loss of $411 million for the year. So going from a gain of or earnings, positive earnings of $473 million to a loss of $411 million, that's important. You need to understand what's going into that. Now, another way to assess earnings quality is just to go right to the cash flow statement. I talked about how the income statement was focused on matching revenues and expenses in the same period by using accruals. The cash flow statement doesn't care about that. It is purely about when the cash flow is received. So one of the questions that the cash flow statement can answer is, are the reported earnings actually translating into real cash flow? So cash flow statements are, often quite complicated. There's a little bit of a mess involved, but if you just focus in on some of the important line items, you can get a lot of great information. And I'm going to go back to that original example of the company that had 22 million in reported earnings, but those non-cash items on their income statement. So we could go right to the cash flow statement and we can see that those non-cash items, those items that we thought were non-cash items, are in fact non-cash items. They're factored right out of earnings to get to cash flow. So positive earnings of 22 million is actually negative cash flow of 12 million. This would be an example of a company that essentially has no earnings quality. How do we measure earnings quality? Well, one way to do it, one really simple way, is just to focus on cash conversion. So that's just operating cash flow divided by net income. So what percentage of net income is turning into operating cash flow? We want to see this number meaningfully above 100%, definitely above 100%, ideally above 120%. Below 100% indicates lower earnings quality. And if you're getting into a situation where you have positive net income, but negative operating cash flow, then that's essentially no earnings quality. And I'm going to end this off on a positive, and I'm going to show you an example of a company that has a great cash flow statement and very high earnings quality. Right up here at the top of the operating section of the cash flow statement, you can see in the most recent year, they reported $606 million in net income. But when we go to the bottom, they've generated $1.5 billion in operating cash flow. So more than twice their net income into operating cash flow. So this is a great example of a company that we would have no concerns with respect to their earnings. In fact, their earnings are potentially understated in this case. And for anybody who's curious, the name of this company is Fortinet. It's a cybersecurity company that we've had under coverage for years. Excellent. So that concludes my presentation. If you guys have any comments, questions, I'd love to hear it.
Show me the money.
Yeah, you love that slide, didn't you?
That's another movie I've never seen. Yeah.
Jerry Maguire.
Watch a movie, Brennan. Watch a movie.
Well, I was sick. I did watch Apocalypse Now, and I enjoyed it.
It's almost like Jerry Maguire. There's a real similarity towards those two movies.
Yeah, I'm sure there is.
Good. That's good. No, it was well done. You know why we're not commenting on it? Because we've seen you present it 14 times over the past several weekends. So we fell asleep halfway through. No, it was well done.
I don't think you paid attention any one of those times. So
I did.
Pardon? You started talking and I just drifted off.
Exactly.
You know what's happening. No, that's good. we know we got to get through this really fast. So we'll get to our next segment. I'm going to take our star of the week. That's Bowman Consulting Group Limited, symbol BWMN on the NASDAQ. Stock trades at $18.10, $242 million market cap, up 20% in the last 2 days. What do? Bowman is an organic growth and acquisition professional services firm, essentially engineering solutions, including planning, construction management, commissioning, environmental consulting, geomatics survey, land procurement, and other technical services to customers in a diverse set of industries and regulated end markets. Now, why did the stock price jump this week? Well, our clients will know. They'll be getting full update on this. They announced record third quarter results that exceeded consensus estimates, and they raised their guidance. So you do those things even in this market, and your share price goes higher. Gross revenue was up 79% to 71 million from 39.7 in the same period last year. Organic part of that was 23%. Net income was up to 34 million, 26 cents per share. That's reported, up from 400,000 or 3 cents. That included a one-time tax benefit. So EPS on a normalized basis was around 14 cents, up from a small loss in the same period last year. Now, adjusted EBITDA margin came up to 14.8% from 12.4%, so growth there. The gross backlog in the business was up 65% to 230 million over the same period last year. So Bowman also, like I said, increased its 2022 revenue and adjusted EBITDA guidance higher. Once again, it's done this a couple times already this year, and introduced growth guidance for 2023. These are all solid positives and all led to the 20+% gains we've seen in the stock in the last 2 days. But most importantly, they give Bowman the coveted status of star of the week.
Nice.
And Bowman's one of a couple of companies that we consider to be part of our I would say U.S. infrastructure development theme, right? And the theme being that infrastructure in the United States is in dire need of upgrade and maintenance, repair and replacements. You're talking about roads, bridges, institutional infrastructure, wide range. It's an issue in the United States, and so it's an area that we've identified as a strong investment theme, and we had a recommendation in that area for years, NV5 Global, that performed extremely well even through difficult times, and we almost see Bowman as kind of like a miniature version of that.
Yeah, and certainly the management team at Bowman, when we interviewed them, they were well aware of NVE and patterned themselves after them, and said this stage where Bowman was about 10 years ago, essentially, is what they're looking at, and trying to grow the business that way. If they can execute half as well as NVE did, the company could continue to have legs in the market.
Yeah, and we'll talk to them again before we get that next update out for clients, for sure.
For sure. Now, finally, we're going to get to Brennan. He's hitting the mailbag here. If he can speak, if he's liquid, or have you hit the cough drops or whatever before this? Are you ready? Are you ready? That's all.
Oh, I'm ready.
Okay.
Yeah,
announces. You're going to answer a listener question on Fiverr International, symbol FVRR on the New York Stock Exchange.
I sure am. So this question came in from Tyler, and he says essentially, if FVRR drops below $20 per share, is it worth taking a shot at? ? In his question, he's kind of specifically, he says he's wondering if massive job cuts from tech companies, etc., could be a catalyst for the gig economy. So Fiverr International Limited, FVRR on the New York Stock Exchange, currently trading at a price of just or around $40 per share, and has a market cap of about $1.53 billion. So the company operates an online marketplace worldwide, enabling sellers to sell their services and buyers to buy them. The company's platform includes approximately 550 categories in 9 verticals, including graphic and design, digital marketing, writing and translation, video and animation, music and audio, programming and technology, business, data, as well as lifestyle. And the company also offers freelancers software solutions for invoicing, organizing workflow, learning, and development offerings, and has a subscription-based content marketing platform. So some key points here is the stock did IPO in June of 2019 at a price of $21 per share. And it did have some pretty great early success in the COVID-fueled economy, but it is now down about 88% from its early 2021 highs, which you can see here on my chart. So the company just reported its Q3 2022 results on November 9th. Revenue was up 11% to $82.5 million. And this was driven by active buyers, which grew about 3% to 4.2 million. Spend per buyer grew about 12%, and Fiverr's take rate increased to about 30%, up from 28.4% for the same quarter last year. If we look at adjusted EBITDA, it was actually down about 10% to 6.6 million. And on a GAAP basis, the company is still losing money with a GAAP net loss per share of about 31 cents compared to a loss of about 39 cents for Q3 of 2021. And adjusted EPS, so the company does quote an adjusted figure as well, and they provided that they actually earned about 23 cents in adjusted earnings, which is up from about 21 cents in Q3 of 2021, which is last year. So Aaron did just, do his recent segment on this essentially. So let's really take a look at why the earnings here are so different from the GAAP. So the only reason that Fiverr is posting adjusted profitability here is because of its large share-based compensation expense, as it is adding back approximately $17.6 million, or this would equate to about 47 cents per share in earnings, which generally we don't like to see, as this is holding the company back from GAAP profit. And this is essentially dilution. This is an actual cost that is being faced by the company. So I don't know if we can just completely ignore it. So moving on, the company did provide guidance as well. And looking forward, Fiverr anticipates fiscal year 2022 for revenue to be about 337 million at the midpoint, which would equate to about 13% growth year over year. As well, adjusted EBITDA is looking at about 22.5 million, which is actually a decline of about 2% year over year. And keep in mind, as you can see here on the page, we have seen the company now reduce its initial fiscal year 2022 revenue target by about 10% and its adjusted EBITDA guidance by about 25%. So, that's not something that we do like to see. The company does have a nice cash position on its balance sheet, but it still has a net debt position of just under 86.6 million. And on a forward enterprise value to adjusted EBITDA basis, the stock trades at about 72 times, which is not cheap. And even on a price to sales basis, we're looking at a multiple of about 4.6 times. And on a trailing basis, it trades at about 54 times adjusted earnings. That's all for a company which is growing revenue at about 13%, is not profitable on a GAAP basis due to share compensation, essentially. And it appears that growth is beginning to slow, as in the last 2 quarters, revenues were down sequentially, which is the first 2 quarters of declines experienced in the last 12 quarters. So to conclude here, the gig economy is an interesting space, as it allows people to become the makers of their own destiny, which is why many millennials are gravitating to this type of freelance work, as it provides a bit of freedom and independence from an overbearing employer, such as Ryan. Just kidding, Ryan. You're not overbearing. Just kidding. And as well, like looking at what Tyler was saying, an overall macroeconomic downturn and job cuts could help Fiverr find more supply of skilled workers for its gig economy platform. But what would happen to the demand side of the equation? Like, I would argue personally that demand for services would likely slow, potentially leading to lower revenue for Fiverr. So there might be, more freelancers on the platform, but, demand for their services might wane as well. So it might not actually benefit them as much as you think in a macroeconomic downturn. So I think at this point in time, we would stay on the sidelines given its pricey valuations, guidance, which has been revised much lower, and what appears to be slowing growth. Even to answer your question, Tyler, if the stock was below $20, it would definitely be more appealing, as the stock, or at that point, the stock would be trading at about 36 times adjusted adjusted EBITDA and 27 times adjusted earnings. But again, even at those valuations, the low teen growth isn't that appealing. And I'm joking, Ryan.
Yeah.
You're not an overbearing.
Yeah, you're done. So no, no, I mean, I'd be a hard no for me. I mean, I get what's trying to be accomplished here in the reasoning behind, looking at this company, but even if the stock dropped to that range, you're talking about revenue growth of 12 to 13% and adjusted EBITDA growth, and this is adjusted earnings, not real earnings. Adjusted earnings was limited as well. If it had absolutely high growth, you might be able to sell somebody on it, 6 to 8 months ago. Now the market wants actual earnings and higher growth than that to be able to pay a multiple. So, I mean, unless something changes and growth upticks, I think the company's actually vulnerable.
Yeah, I would agree with that.
There's almost nothing that I see. So if you just in terms of reported earnings, they have nothing, or
it's a loss.
A loss.
Yeah, it's a loss. Yeah, I mean, maybe at 10 or 12 times earnings, I'll look at it. That's a big.
Yeah, I mean, to me, it looks like right now it's
in this market
red
for 36
flags.
times earnings. There's much better companies out there in the tech space to buy.
And I'd also like to add too, it's headquartered in Tel Aviv, Israel. So I mean, generally we do see companies there kind of
actually trade at a discount. Yeah,
exactly,
a significant discount to others in the market, to be honest. And so again, another, not completely a red flag, but it's something that would actually give us a pause to say, well, this actually deserves a discounted model to some of the other tech names out there. We see that. I think that we've used their services, to be honest. It's a good business, but there's many companies out there that you say use their services over the past 3-4 years, and they've been priced ridiculously in the market. This stock has been absolutely cratered, and to be honest, it probably deserves to get taken out and beaten a few more times, and can go lower.
Yeah.
Not that it's a bad company; it's just the valuation for us. Yeah,
exactly.
I think that does it for our show this week, doesn't it? We got it in under the wire.
So. We did.
All right. Well, I'd like to thank everybody for listening. Thank Brennan for making it through it. Your mom's been cheering you on in the background. We know, we can hear her there.
Thanks, Colleen.
It's true. Keep smashing the subscribe button. Keep your questions if you're on Google. If you're listening to this as a podcast, keep liking us or rating us on iTunes. And hopefully next week I'll have most of my brain cells back after having a fever for about a week here. That'll be great. Everybody, I'd like to wish you out there profitable investing. Thank you.
All right. Thanks a lot, everyone.
Thanks, everyone.
Thank you.